Attention, Canadians. Do you feel disconnected from our current political system? This could be our last chance to take a real legal stand for our rights. It's time to shift the political power to its rightful owners, the Canadian citizens and Indigenous peoples of Canada. Dive into our history, understand the need for change, and embark on the quest for true democracy. Are you concerned about our nation's commitment to human rights and self-governance? The power shift to freedom aligns with vital treaties and international laws enabling us to claim our rightful place as collective head of state. We advocate legally replacing the Crown, King Charles III, and our partocracy system with a true democracy, the peoples as the true collective head of state with veto power over our governance, to ensure your voice counts more than party interests. When our national collective civil and political rights are respected, your influence on policies will be direct and impactful. Join us on this noble struggle to make every Canadian and Indigenous peoples a meaningful participant in our future as collective head of state, which was legally owed and kept from us since the patriation of our Constitution, an official decolonization from the United Kingdom of 1982. It's time to correct the past of our government's lies and omissions to the people of our great country before it is too late. People 15 years old and over can sign our Canadian People's Referendum at canadianreferendum.ca and unite for our rights as the collective head of state in our Constitution. Together, we can be the example in reshaping Canada's future, not just for us, but for all peoples worldwide, once and for all. Are you ready to be part of this transformative movement? Join the Power Shift to Freedom movement by the Canadian People's Union and be part of a bold vision for Canada's future. Visit thecpu.ca for more details. Embrace and face the change required on your part to shape our future.
This speech by the Governor of the Bank of England, which, as many of you know, was supposed to be in Edinburgh, for the University of Edinburgh, but the beast of the East has kept him here. I guess of the many things that Mark Carney has brought to this country from his home country, a resilience to cold weather, unfortunately, is not one of them yet, but I'm sure you're working on it. As I say, a warm welcome from Bloomberg, but we thought it was only right for the economics lecturer from the University of Edinburgh to introduce the Governor himself. So, Sean Brecklebank, do you like to come?
Thank you. So good morning, everyone. So it's my pleasure to introduce Mark Carney, the Governor of the Bank of England, to you today. He's going to be sharing his thoughts on the nature of money and how it's changed, as well as the future for cryptocurrencies and the viability of central bank digital currencies. As was just noted, this speech was meant to take place in Edinburgh. However, no one can get to Edinburgh, including me. So that's why I'm here. Not that it's the worst place to be. And of course, Bloomberg has very kindly offered to host this in their London studio. This was meant to be a talk for the inaugural Scottish Economics Conference, which is organized by 50 students across 6 Scottish universities, led by Harry Spooner and Oscar Birrell, who are hopefully listening up north somewhere. And it's really, I think, a testimony to the value of undergraduate collaboration. Despite multiple setbacks to the conference from the beast from the east, I wish them the very best of luck up in Edinburgh from here in London. And over to you.
Great. Good. Well, thank you very much, Sean. Thank you, Stephanie, Constantine, Bloomberg, for hosting this. And let me add my congratulations to the students, the 50 students, and by extension, the several hundred students that are participating in this inaugural Scottish Economics Conference. Really applaud the initiative in creating this and their determination in pulling it off, and they are pulling it off. And my only regret, as Stephanie indicated, is that the beast from the east, Emageddon, are preventing me and Sean and undoubtedly a few others from attending in person. Although, you know, given the topic today, it's strangely appropriate to be joining them virtually. So I'm going to start off in talking about the future of money, start with the present of money. And if I were there, I'd be handing out 20-pound notes. Just I want to make that clear, because it's just part of how the Bank of England promotes the good of the people and the students. But this banknote is significant. It's significant because it honors Adam Smith, the great moral philosopher and hero of the Scottish Enlightenment. It's significant because it's a significant amount of money. If you're up in Edinburgh today, it's enough to buy you a beer and, well, a couple of pints, actually, a couple of pints and a burger at the Pear Tree Pub this evening. If you fancy a quieter but still highly stimulative night in, it will buy you copies both of The Wealth of Nations and The Theory of Moral Sentiments at Blackwell's. But it's significant, really, because without money, the decentralized exchange of Smith's invisible hand couldn't operate. Money unlocks the specialism of labor in the pin factory and the great increase in the quantity of work that results. And only money can solve the coincidence of wants between the butcher, the brewer, the baker, and the student on a Friday night. Now, many of those listening, and I believe watching at the university conference, probably don't see Adam Smith notes that often. And that's not just because you're impoverished students or because you live in Scotland, where you're more likely to encounter Sir Walter Scott or Nan Shepherd on a banknote when you do have cash. But it's because you probably use electronic forms of money, such as debit cards or electronic wallets on your phones for your everyday purchases, or go online for larger ones. And a number of you may hold other forms of money, electronic money, crypto or virtual currencies such as Bitcoin, Ether, or Scotcoin. And a few may view paper money and even the Bank of England itself as archaic vestiges of an old centralized order of payments that will soon be swept away by a digital distributed future. And that's my topic for today, the future of money. Specifically, how developments in money and payments technologies could transform our economy in ways both good and bad, and how, for the good of the people of the UK, the Bank of England is helping to manage the potential risks and to realize the promise of the future of money. So let me start with a few definitions. In The Wealth of Nations, as I suspect, Sean, all of your students know, Adam Smith defines money by the roles it plays in society, in particular, how well it serves as a store of value, as a medium of exchange, and a unit of account. And these functions operate in a hierarchy. There are many assets that people view as stores of value, houses, for instance. But those aren't necessarily used as media of exchange. By comparison, an asset can only act as a medium of exchange if at least two people are prepared to treat it as a store of value, at least temporarily. And for an asset to be considered a unit of account, it must be able to be used as a medium of exchange across a variety of transactions over time by several people. And this hierarchy points to the reality that money is a social convention. We accept that a token has value, whether it's made of metal or polymer or of code, because we expect that others will do so readily and easily. The tokens representing money have taken many forms over the millennia, from cowrie shells in ancient times to cigarettes during the Second World War to mobile phone minutes in modern Kenya. Most forms of money, past and present, have nominal values that far exceed their intrinsic ones, a gap that has meant that money has a long and sorry history of debasement, particularly private money that has inevitably succumbed to oversupply and eventual collapse. But Adam Smith worried also about the potential debasement of public money, and for good reason. Throughout history, governments would often betray the trust of their citizens, be it Henry VIII, reducing the precious metal content of his coins during the Tudor era, Pitt the Younger depleting the gold vaults of the Old Lady during the Regency period, or a pliant Reichsbank financing the government in Weimar Germany. With the wisdom born from such sad experience, most countries have now settled on centralized public fiat money backed by robust institutions in order to provide the public with money that's both highly trusted and easy to use. And most of the institutions that underpin sterling's effectiveness as money are now housed in the Bank of England. In particular, our commitment to the highest quality banknotes that you and the publican can use with confidence, the foundation of wholesale payments, RTGS, which processes over £600 billion per day to the highest standards of efficiency and reliability, the MPC, which conducts monetary policy independently to achieve price stability defined by the 2% inflation target, the PRC, which is charged with ensuring the safety and soundness of our banks and building societies that hold your money, the FPC, with its wide powers to maintain the resilience of the financial system as a whole, and finally, the powers and facilities that provide a wide range of liquidity to banks and other financial institutions in order to promote the continuous functioning of the system during shocks. The bank has been given clear remits by Parliament for these responsibilities, and it has operational independence, pardon me, and it has operational independence to achieve them. It's accountable to Parliament and the public for our performance. This robust institutional framework sets a very high bar for forms of money competing to dislodge sterling. But at present, there's more than 1,000 virtual or cryptocurrencies that are trying to do just that. In the depths of the global financial crisis, the coincidence of technological developments and collapsing confidence in banking systems sparked the cryptocurrency revolution. Its advocates claim that a decentralized cryptocurrency, such as Bitcoin, is more trustworthy than centralized fiat money because its supply is fixed and therefore immune from the age-old problem of debasement. Its use is free from risky private banks. It doesn't touch risky private banks. And thirdly, those who hold it can remain anonymous and therefore free from the ravenous eyes of tax authorities, or worse still, law enforcement. Some also argue that cryptocurrencies are more efficient than centralized fiat money because the underlying technology cuts out intermediaries like central banks and financial institutions and allows payments to be made directly between the payer and the payee. In a spirit of dystopian fear and libertarian optimism, the first or Genesis Bitcoin block was accompanied by the headlines from the Times, Chancellor on the brink of a second bailout for banks. So how well do cryptocurrencies fulfill the roles of money? The short answer is they're failing. Cryptocurrencies are poor stores of value. Over the past 5 years, the daily standard deviation of Bitcoin was 10 times that of sterling. Consider if you'd taken out a £1,000 student loan in Bitcoin last December to pay your sterling living costs for the next year. You'd be short about £500 right now. If you'd done the same last September, you'd be ahead by $2,000. It's quite a lottery. And Bitcoin is one of the more stable cryptocurrencies. This extreme volatility reflects that cryptocurrencies have neither intrinsic value nor external backing. Their worth rests on beliefs about their future supply and demand, ultimately about whether they'll be successful as money. Thus far, rather than a sober assessment of their future prospects, the prices of many cryptocurrencies have exhibited all the classic hallmarks of bubbles, including new paradigm justifications, broadening retail enthusiasm, and extrapolative price expectations reliant in part on finding the greater fool. And far from being strengths, the fixed supply rules of cryptocurrencies such as Bitcoin are serious deficiencies that would impart a deflationary bias on the economy. If those who cannot remember the past are condemned to repeat it, recreating a virtual global gold standard would be a criminal act of monetary amnesia. The most fundamental reason to be skeptical about the longer-term value of cryptocurrencies is that it isn't clear they'll ever become effective medium of exchange. Currently, no major high street or online retailer accepts Bitcoin as payment in the UK, and only a handful of the top 500 US online retailers do. For those who can find someone willing to accept in cryptocurrencies, the speed and cost of the transaction is generally slower and more expensive than payments in sterling. And that's because the more heavily used cryptocurrencies face severe capacity constraints compared with other payment systems. For example, Visa can process up to 65,000 transactions per second against just 7 for Bitcoin. If you use a debit or credit card in the UK, the transaction's completed in seconds and without exchange rate risk. In contrast, Bitcoin users face queues of hours, and those waiting to get to the front to make time-pressing payments, for last orders, for example, need to offer up a transaction fee sufficiently large to persuade Bitcoin miners who verify and process the transaction to do so quickly. These fees, the fees that are paid, vary through time. They reached £40 in late last year. They're currently around £2, but even that's expensive relative to cash, cards, or online payments, which cost the retailer around 1.5 pence, 8 pence, and 19 pence, respectively. So even at its low volumes, the costs of Bitcoin mining are enormous. Its current annual electricity consumption is double that of Scotland. In comparison, the global Visa network's energy use is less than 0.5% of that of Bitcoin, despite processing 9,000 times more transactions. So given their poor stores of value and inefficient and unreliable media of exchange, it isn't surprising that there's little evidence of cryptocurrencies being used as units of account. There are the few retailers that quote in Bitcoin in Britain update at a very high frequency in order to maintain stable prices in traditional currencies such as sterling. And the bank isn't aware of any business that accepts Bitcoins in payments that also maintains its accounts in Bitcoin. Now, even though the prospects of replacing fiat money are tenuous at best, cryptocurrencies are of growing interest to policymakers, many of whom prefer the term crypto assets expressly because they aren't true currencies. And I'll adopt that convention for the rest of my remarks. Crypto assets raise a host of issues around consumer and investor protection, market integrity, money laundering, terrorism financing, tax evasion, and the circumvention of capital controls and international sanctions. The bank's Financial Policy Committee is currently considering the risks posed to UK financial stability, and internationally, the Financial Stability Board will report to the G20 in Argentina later this month on the same topic globally. At present, in my view, crypto assets do not pose material risks to financial stability. In part, this is because they're small relative to the financial system. Even at their recent peak, their combined global market capitalization was less than 1% of global GDP. In comparison, at the height of the dot-com mania, the valuation of technology stocks were a third of global GDP. Now, authorities are rightly concerned that given their inefficiency and anonymity, one of the main reasons for the use of crypto assets is to shield illicit activities. This cannot be condoned. Anarchy may reign on the dark web, but in the UK, it's just a song that your parents used to listen to. Moreover, parents like me, once trying to be cool. Moreover, structural vulnerabilities in cryptocurrencies mean that they're inherently risky, with extreme price volatility and poor market liquidity due to fragmented markets and highly concentrated holdings, which in turn facilitate manipulation and misconduct. These vulnerabilities are compounded by operational and technological weaknesses, as evidenced by a series of major crypto asset heists. In addition, there's unease that the combination of these vulnerabilities and widening retail participation could damage the reputations of those financial institutions connected to crypto asset markets, and in extreme circumstances, even undermine confidence in the financial system itself. So authorities need to make some decisions. They need to decide whether to isolate, to regulate, or to integrate crypto assets into the financial system. A few jurisdictions have banned them outright, and some, most prominently China, have sealed them off from the core of their financial system. If widely adopted, however, isolation risks foregoing potentially major opportunities from the development of the underlying technologies. A better path, I'd suggest, would be to regulate elements of the cryptocurrency ecosystem to combat those illicit activities, promote market integrity, and protect the safety and soundness of the financial system. Indeed, the time has come to hold the crypto asset ecosystem to the same standards as the rest of the financial system. Being part of the financial system brings enormous privileges, but also great responsibilities. And in this spirit, the EU and the US are requiring crypto asset exchanges to meet the same anti-money laundering standards and counterterrorism standards as other financial institutions. And conduct and market regulators are considering how to classify crypto assets in order to determine the appropriate level and type of investor protections. In my view, holding crypto asset exchanges to the same rigorous standards as those that trade securities would address a major underlap in the regulatory approach. And as the SEC and here in the UK, the FCA have argued forcefully, so-called initial coin offerings will not be allowed to use semantics to avoid securities laws designed to protect investors, retail investors in particular. Finally, prudential regulators like the bank's PRC are in the process of clarifying how the existing regulatory requirements for banks, including capital, apply to any future crypto asset exposures. So, I trust you may have got a bit of the drift by now, gathered by now, that for many reasons, in my view, the crypto assets in your digital wallets are unlikely to be the future of money. But that isn't meant to dismiss them. Their core technology is already having a major impact, and bringing crypto assets into the regulatory tent could potentially catalyze innovations to better serve the public. Indeed, crypto assets help point the way to the future of money in three respects. First, by suggesting how money and payments will need to adjust to society's changing preferences. Secondly, through the possibilities their underlying technologies offer to transform the efficiency, reliability, and flexibility of payments. And thirdly, by the questions they raise about whether central banks should provide a central bank digital currency accessible to all. And I want to take these in turn. First, crypto assets are part of a broader reorganization of the economy and society into a series of distributed peer-to-peer connections across powerful networks. People are increasingly forming connections directly, instantaneously, and openly, and this is revolutionizing how we consume, work, and communicate. Yet the financial system continues to be organized largely around a series of hubs like banks, payments, clearings, and settlement systems. And crypto assets are an attempt to create the financial architecture for peer-to-peer transactions. So even if the current vintage isn't the final answer, it is throwing down the gauntlet to the existing payment system. And these existing systems must evolve to meet the demands of fully reliable, real-time distributed transactions. The second challenge of crypto assets is their underlying technology, obviously particularly distributed ledger, which can do many things. It can increase the efficiency of managing data, improve the resilience by eliminating central points of failure, enhance the transparency and auditability of transactions, and expand the use of straight-through processing, including with smart contracts that automatically update and, if appropriate, pay. These properties mean that distributed ledger technology could transform everything from how people manage their interactions with public institutions to how businesses manage their supply chains. Now, the third challenge is that crypto assets raise the obvious question about whether their infrastructure could be combined with the trust inherent in existing fiat currencies to create a central bank digital currency, or CBDC. Now, currently, only banks can hold electronic central bank money. To be truly transformative, a general purpose CBDC would have to open access to everyone. And the Bank of England has an open mind about the development of a CBDC and an active research program dedicated to it. That said, given the technological shortcomings in distributed ledger technologies at present, and the risks with offering central bank accounts for all, a truly widely available and reliable CBDC does not appear to be a near-term prospect. Moreover, its desirability depends on the answers to a series of big policy questions. And while these are largely for another speech, you'll be happy to know, I would note that a general purpose CBDC could mean a much greater role for central banks as part of the financial system, a role that could potentially mean central banks disintermediating commercial banks in normal times and running the risk of destabilizing flights to quality during times of stress. And there are also broader societal questions, such as how society balances privacy rights with the extent to which the information that would be contained in a CBDC could be used to fight terrorism and economic crime. A general purpose CBDC shouldn't be a solution in search of a problem or an effort of central banks to be down with the kids, especially because there are more immediate ways to give you what you want. So while our research on a possible future CBDC will continue, we're more excited at the Bank of England about the opportunities to transform digital payments now. In particular, the combination of the bank's overhaul of RTGS, that big central payment system, and new technologies promise payment systems that can better serve society's demands for fully reliable, real-time, and distributed peer-to-peer transactions. Now, RTGS is already pretty awesome, but it's also the same age as most of the students watching this, so we're in the process of renewing it. And this could mean more than you might think. Currently, when you pay for your burger and pint at the pub, or your books at Blackwell's, you probably use a debit card, a credit card, or the wallet in your phone. But all of these need to be routed through the card provider's network. Over the past 4 years, the payment-related costs that your publican or bookseller pay and ultimately pass on to you has come down by about 40% to about 8p per transaction. Well, these are small and, as I said earlier, much better than Bitcoin. They remain non-negligible, and that's partly because there's relatively limited scope for them to be competed away by innovators due to restricted access to the UK's major bank-to-bank payment system known as faster payments. Now, the good news is that non-bank payment providers, PSPs, can now access RTGS, and we expect the first of them to do so directly this spring to help drive costs down and service up. So what can that mean? Well, innovative PSPs can deliver a world where you can split around in the pub electronically and instantaneously, needing nothing more from your friends than a QR code on their phone or their mobile number. By doing so, electronic money is effectively becoming much more like its physical relative, allowing genuine, immediate peer-to-peer transactions without the need for a middleman. Our overhaul of RTGS is helping to reduce complexity and costs in other areas, such as cross-border payments, where the bank is leading the efforts of other central banks and the private sector to use central bank money in cross-border payments through synchronized RTGS systems. When coupled with capture of richer payments data that will be made possible by the renewal of RTGS, the system will also help support innovative services for the more effective management of personal and company finances, benefits that will be amplified by the application of open banking. Finally, at the wholesale payments end, the bank believes that the distributed ledger technology could potentially save tens of billions of pounds of capital, currently tied up in settlement, while settlement completes. And while the best of the private sector are working hard to find ways to unlock this value, that tens of billions of capital, the bank is building the new RTGS so that forms of security settlement, including those that use distributed ledger technology, will be able to plug in directly. So let me conclude. So while Adam Smith was famously cautious about the role of the state, he recognized that it should furnish the rules and conditions within which private innovation can flourish. In the monetary sphere, this means providing money which citizens can use with confidence and ease. And the Bank of England delivers just that, from the quality of our banknotes to the stability of our inflation, the resilience of our financial system, and the efficiency and reliability of our core payment system. As we do so, we're overhauling that core payment system, RTGS, so that private innovation can flourish. And by bringing crypto assets onto a level regulatory playing field, we can help catalyze a more resilient, effective, and innovative payment system. With all of these foundations in place, the scene is set for better payments, a better economy, and a better Friday night out. So with that, I will thank you, and Stephanie's going to join me. Yes. Thank you very much.
I'm going to moderate
Take my 20.
some questions from all of you here, but also from the audience who I know can see us, we can't see them, sitting in the University of Edinburgh, the students there, and they've put forward some questions that I'm going to go to first. So Alexandros Aristidou from the University of Edinburgh has asked, I guess it's kind of summarising many of the things in your speech, do cryptocurrencies undermine the bank's ability to regulate financial markets, or do they represent new opportunities?
Yeah, well, I listed many of the challenges with crypto assets, so I think I'll focus my answer on the opportunities. And I think the opportunities are that they point the way to where the system has to go to be able to enable these peer-to-peer transactions, distributed transactions, the first thing. And then secondly, they provide some of the underlying technology, or they provide an underlying technology that can be used in many of the solutions. And we're working hard. We've been working with DL technology, distributed ledger technology, for about 5 years. We are creating a system, the core of the system, in a way that private innovation can plug into the system more readily to provide these types of services that crypto assets are trying to do. And I think, as I said in the speech, one of the very positive things about this flurry of activity in crypto assets is they really are throwing down the gauntlet of where the system needs to go, what it needs to provide. And in that regard, they are creating a lot of opportunities.
This is you're sitting in the pub doing the instantaneous
sitting in the pub
doing
the yes, I can't hide in the pub. I won't have the excuse of my usual, I left my wallet in my other coat excuse.
And another question from
I'll have to say I left my phone in my other coat.
Well, actually, it sort of follows on from that a little bit. Kate Bradley from the University of Dundee. How does one reconcile the tension between your mandate to ensure stability, but also the great steps you have taken to support radical innovation in finance. How are you managing those two things?
Yeah, it's, I think we have to, there's certain bits of the core of the financial system that we have to protect. We have to maintain certain standards. So I'll take the example of RTGS, the system at the core. We did look at whether we could apply, actually run it on DL.
That's the real-time settlement.
The real-time settlement system, 600 billion pounds a day. You know, it has to meet standards of five sigma standards. And DL is just not ready for that yet. With respect to financial institutions, so that's an example of how you know, that's one side of the equation. With respect to financial institutions, whether it's banks, building societies, financial market infrastructure, there are ways to engage with that sector, provided you are taking the appropriate risk mitigants, provided they're meeting the standards of anti-money laundering, counterterrorism financing, provided you're reserving for the volatility, the extreme volatility you can see. I think last point I'd make is that part of the way you resolve the tension is actually you bring some of that ecosystem, in fact you bring that ecosystem into the regulatory net, into the tent, most of which is regulated by other authorities, so it's decisions for other authorities, but you know, to the way I look at it, there's no reason why crypto exchanges should be outside the net. And one of the things that's being discovered, for example, with the regulation of the futures, is that there is then a view into the underlying exchanges. And not everything, this is a massive euphemism, meets the standards one would expect of markets in terms of—
Your reference to anarchy.
Anarchy, manipulation, and misconduct. And who suffers from that? That's the retail investor who gets brought into those. So bringing it in actually helps raise standards. Some will not be able to meet those standards and fall by the wayside. That's fair. Others will innovate in a way that rises to those levels. So I think that's how you resolve the tension.
As you know, there has been this sort of all men economists and even senior members of the bank have done their speeches about Bitcoin over the last few years. There's been a kind of standard conclusion, which is, you know, don't look necessarily at Bitcoin, but the distributed ledger technology, that is interesting. That's something we're looking at. You said you've pursued it a bit. You're not sure it's ready yet. Is that one of those things that we sort of exaggerate the importance in the short run and then really miss the importance in the long run, that it's just going to be a 10, 20-year thing that transforms the financial system?
I think that's, you have to keep open that possibility without question. And so part of what I was saying there and part of our attitude is always think about the end user. Think about the person in the pub or the business managing their supply chain. What are they trying to get from this new technology? Or what problem is it trying to solve? How can the existing system adapt, even radically adapt, in order to provide it? In parallel, be all over the technology and expect that it's going to innovate, particularly if it's brought into the regulatory net, because the standards all of a sudden go way up and it has to innovate, and be aware that it can be moved. Now,
10 years, 20 years? It could be
it's tough to say. It's also possible that it won't achieve that level. And I think one of the things that, you know, I would distinguish between the currencies, and this isn't universally true, I obviously won't name individual ones, but you know, most currencies don't actually, you know, there's nothing proprietary about the underlying, the technology will move beyond them. So if you own the currency, you don't really own the underlying application, if you follow. So you don't even have the option value on the technology, as you would if you owned a company that had an underlying technology.
Okay, there's a final question from the students, because I think it's a fun one. It's Gustav Birol from the Aberdeen Business School said, how did Bitcoin manage to transform the risk appetite of the average person who had been so wary of investing in the financial markets after the 2008 crash?
Well, couple of things. I think that one of the things in financial markets as a whole, and I think society, you know, memory is, particularly financial memory, tends to be, you know, kind of 7-8 years, and the sort of pain of previous experiences reduces. Certainly in professional financial markets, that's the case. Logically, it doesn't make sense, but that's what tends to happen. Secondly, I think a lot of the I mean, a lot of the surge into these assets has been it's been a different generation, in part because it maps. They're trying to accomplish something with which that generation is quite familiar, right? So they're trying to solve an issue that they expect to be solved. So the investment case makes sense with the way they live. Okay, so and that generation doesn't have that memory of the crash. The crash. I mean, Sean, I don't know if you agree, but I know when I go to universities and things, you might as well be talking about the Great Depression when you talk about 2008. I mean, for me, it was yesterday, but it's a long time. It's still it's got it totally under control. So I think it's partly that some people didn't live through it. Some of it's the memory goes away, and then also some of it is you know, a portion of people's, you know, it's an option. It's a proportion of people, you know, small proportion of people's wealth that they put in, hopefully. And what you worry about, of course, and you know, it's not our job to save people from themselves in this regard, but you worry about people who get caught up anytime you have extrapolative behavior, a bubble. It's the people who come in later, who come in with all of their net worth, who pay the heaviest price, unfortunately.
Okay, some questions from here. Front row.
Thank you for your presentation. Quick question on the regulation. So how difficult do you think it would be to regulate parts of the cryptocurrencies, given that the technology is electronic, decentralized, and often anonymous?
Well, it's in terms of the exchanges, they're housed somewhere, they're powered somewhere. I mean, it's if it kind of will. If there's a will, there's a way. It's actually relatively straightforward decision, and you see that the decisions that have been made in China, in Korea, in other jurisdictions, you know, I would say it's relatively straightforward. First point. Second point is that, and there's a wide spectrum, as I suspect you appreciate, in terms of the underlying, but the anonymity, it's pseudo-anonymity in many cases. And one of the issues is the extent to which that pseudo-anonymity is unlocked and the chain is followed back, particularly with respect to illicit activities. So there's opportunity as well on that side.
Okay. I think you quote some of the. Do you basically buy the research that says it's anything from a quarter to a half of what's on these exchanges is actually related to illicit activity?
I think I would have. Short answer, don't know, haven't audited it. Directionally, that probably was more true a year ago, before
all these young people.
Well, yeah, before the surge, because a series of people, coming in, but I think one of the issues is that there are still some. In many cases, there's quite concentrated holdings, and the possibility. So I'll be polite. The temptation for manipulation when you have a concentrated holding on an unregulated exchange is potentially very high, and I would put that in the camp of illicit activity.
Okay, there we go. Yeah.
I'm here behind.
Yeah, sorry.
Bill Schomburg from Reuters. Given the differing approaches among national regulators around the world, how quickly do you think you can see coordinated action at the FSB at G20 level on this issue?
I think it's a very good question. I mean, these are national issues. I suspect they will remain national issues for some time. I think that we will have good discussions at the G20 and at the FSB. As I think I flagged in my comments, most of the issues are actually not FSB issues. They're not financial stability issues. I don't want to prejudge the views of the FSB, but at least my view is that there aren't material financial stability risks. If you're a conduct regulator, though, or a market regulator, there are more material risks. And if you're the FATF and you're worried about money laundering and terrorist financing, there are more material risks. And so those bodies will have to work it out. But I would have a greater expectation for a series of national steps rather than some big coordinated approach. But again, it's not solely for me to decide, obviously.
Yeah.
Governor Carney. Ed Robinson with Bloomberg. You mentioned that exchanges should be brought into the regime that regulates the securities markets, the existing markets. But these exchanges trading crypto continue to grow, and many continue to remain offshore and seem to be intent on keeping that way. If they grow to a level that's quite sizable, one that would be worrisome to you and your counterparts, what actions would you endorse in reining them in, exerting some kind of control?
Well, it's, I think first you have to, you establish the principle, which again, national authorities will need to do, but you see various ones of them moving in the direction. I'd make a legal point if I can, which is that in some cases, the existing legal framework makes it difficult because they're not securities, and I just argued they're not money. You know, there's something in between. Now that's a semantic issue. It might be a legally relevant semantic issue, but it's an issue authorities in those countries have to decide ultimately how to address them. But if you're a retail investor and the world moves towards, or major jurisdictions move towards regulated exchanges for crypto assets, and you have a choice between going on a regulated exchange versus one that's offshore, that is more likely to be subject to manipulation, misconduct, cyber risk, operational heist. You know, in the end, there's an element of caveat emptor, but also there's an element of the market I would expect move to the higher standard, as would the better crypto assets. And that's what you want, because that's what drives better innovation, better service ultimately.
Any more? Come on, you've got the Governor of the Bank of England talking about the future of money. I'm sure you can... all right.
Hi, sorry, I'm over here.
Yeah.
It's Nick Dimitri from Jones Day. You mentioned the advent of CBDCs or CBCCs, so central bank issued cryptocurrencies. And I wondered whether you thought that might actually have an effect on the liquidity of the crypto assets themselves, such that if there is, if there's fungibility, then the movement in between CBDCs and crypto assets would be much more fluid.
Yeah, there's two sides. I don't think this is exactly what you were saying, but I'll make this comment, which is one of the considerations in creating a CBDC is that you potentially, at least in this environment, would skim off some of the intense interest in crypto assets, and so your currency would be less likely to reflect, the fundamental values that drive the currency, such as drive sterling, but would reflect, the new era, because it would be the safest way to be expressed in the new era. And so as a central bank, that's an entirely different element to the monetary policy transmission mechanism. And it's one of the reasons why, even if you can solve the technical issues and address, I do think you need to address the broader societal questions, not as a central bank, it's a society issue. You want to proceed in quite a deliberate way. Does it enhance the? Yeah, it would arguably. I think you would have both of those effects in terms of the exchange of which I think your core of your question, the crypto asset into the CBDC. But I think the use case for the CBDC would dominate that effect. So I think it would be a greater crowding out effect for the crypto asset, which is, again, to loop back, why you have to be careful not to sort of jump in to be down with the kids, as I said, and then end up with an overvalued currency as a consequence of being out there. And then the last point I'll make, if you try to address that issue by restricting the access to the CBDC, you potentially create an internal exchange rate between the sterling CBDC and other sterling, which isn't highly desirable either.
That was actually one of the questions from Hugh Rylands from the University of Edinburgh. Was are you considering an initial coin offering for a central bank created cryptocurrency?
Wow.
To be up with in with the
that
kids.
Would be
or
Not? Well, look, it's no is the short answer.
Plastic, maybe.
I think the question. I can understand why Hugh asked the question, and part of the issue is with time, if we go down the track, as we go in parallel down the track of pretty radical innovations at the core of the system, and then that the private sector takes advantage of, the kind I was talking in the speech, if we go down that track and it's reaching its natural end, and there's a bigger return from the CBDC, we want to be in a position, so, in a slight horse race, that if a CBDC ultimately made sense, that we would be able to implement it. And so he's right to challenge it. I don't think we would do it as an ICO,
But at the limit, if you're giving every household in Britain the capacity to go to a safe asset in times of trouble, isn't the risk that they'll go to a safe asset in times of trouble?
You're absolutely right. That is, and my colleague Ben Broadbent made this point a couple of years ago in a speech, and it's one of the issues. So giving everybody an account at the Bank of England is not a desirable way of doing it, because they will just, in stress, you would logically switch everything out of your building society or bank into the Bank of England to be absolutely
queues going into the bank are bad enough as it is.
Well, we're working on that. We're working on that. But the other side of it, Stephanie, is that let's say we solve that issue through a token-based one. Then potentially we've disintermediated the banks relative to the very large amount of distributed money out there. Then we have a huge balance sheet and asset side of the balance sheet. Well, do you really want me making the first decision, or me or somebody like me, making the first decision of credit allocation in the economy? So where do we put that money? Do we just give it to the government? Cue my remarks about the Reichsbank. Do we make a decision about credit allocation? Again, not ideal. So there are lots of, not just practical issues, like technical issues. There are a lot of fundamental issues around with the design.
Thank you very much, Governor. I think that's probably all we have time for, and I will just comment on the fact that we have provided you with even very well-behaved journalists who didn't try and turn this into a question about anything else.
The other B.
Yes. All right, but thank you very much, and thanks to the University of Edinburgh for sort of hosting this, and otherwise Bloomberg and Bloomberg Economics, which I run, was very happy to have you.
Thank you very much, Stephanie, and thank you.
Attention, Canadians. Do you feel disconnected from our current political system? This could be our last chance to take a real legal stand for our rights. It's time to shift the political power to its rightful owners, the Canadian citizens and Indigenous peoples of Canada. Dive into our history, understand the need for change, and embark on the quest for true democracy. Are you concerned about our nation's commitment to human rights and self-governance? The power shift to freedom aligns with vital treaties and international laws enabling us to claim our rightful place as collective head of state. We advocate legally replacing the Crown, King Charles III, and our partocracy system with a true democracy, the peoples as the true collective head of state with veto power over our governance, to ensure your voice counts more than party interests. When our national collective civil and political rights are respected, your influence on policies will be direct and impactful. Join us on this noble struggle to make every Canadian and Indigenous peoples a meaningful participant in our future as collective head of state, which was legally owed and kept from us since the patriation of our Constitution, an official decolonization from the United Kingdom of 1982. It's time to correct the past of our government's lies and omissions to the people of our great country before it is too late. People 15 years old and over can sign our Canadian People's Referendum at canadianreferendum.ca and unite for our rights as the collective head of state in our Constitution. Together, we can be the example in reshaping Canada's future, not just for us, but for all peoples worldwide, once and for all. Are you ready to be part of this transformative movement? Join the Power Shift to Freedom movement by the Canadian People's Union and be part of a bold vision for Canada's future. Visit thecpu.ca for more details. Embrace and face the change required on your part to shape our future.